This is how the most valuable company ever to go public in the United States lost almost half its value in about 5 weeks. In June 2026, SpaceX ran the biggest IPO in American history, and by late July, Wall Street had already slapped it with an ugly label: a broken IPO. Here's how a company that builds the world's most reliable rockets became one of the market's most spectacular falls, and whether it's actually in trouble or just badly overpriced. Let's start at the top, literally the top, because that's where the story begins. SpaceX has always been the underdog that refused to die. Founded in 2002, nearly bankrupt by the end of that decade, it clawed its way to becoming the company that launches America's astronauts. So when it filed to go public in the spring of 2026, with a valuation floated as high as $1.5 trillion, the hype was enormous, and the debut delivered. On June 12th, SpaceX hit the Nasdaq under the ticker SPCX at $135 a share, raising around $75 billion, the largest IPO in US history and a global record. To put that in perspective, it was about 2.5 times the size of Saudi Aramco's offering, the previous record holder. The deal was underwritten by a syndicate of 21 banks: Morgan Stanley, Goldman Sachs, JP Morgan, Bank of America, Citigroup, and more. And here's a detail worth flagging early because it matters later. Up to 30% of the offering was reportedly set aside for everyday retail investors, roughly 3 times the normal allocation for a deal this size. Critics warned that regular people were being funneled into one of the most complex, opaque listings in years. Hold on to that, because it changes who got hurt when things turned. Then came the twist that set up everything else. SpaceX only released a sliver of itself to the public, less than 5% of its shares. Everyone wanted in. Almost nobody could get in. And that scarcity did what scarcity always does. It sent the price soaring. After just its first day, the company was valued at around $2.1 trillion. Within a week, the stock hit $225, and SpaceX was briefly worth more than $2.6 trillion. On paper, Elon Musk had just built one of the most valuable companies on Earth. It lasted about a week. The peak came on June 16th. After that, the only direction was down, and it didn't stop. By July 22nd, the stock had slid to around $115, below the IPO price, nearly cut in half from its high. A company worth $2.6 trillion at its peak was now worth about $1.5 trillion, hundreds of billions of dollars in value, simply gone. That's when the broken IPO label stuck the polite Wall Street way of saying everyone who bought at the debut, including all those retail investors, was now underwater. So what went wrong? 3 things, piling on at once. The first was price. Even after the crash, SpaceX was still trading at around 49 times its expected revenue, one of the most expensive big companies on the entire market. Tesla, Musk's other company, trades at about 15. Investors started asking a simple, dangerous question. Is this thing worth anywhere near what we paid for it? The second was a rocket that wouldn't launch, we'll get to that. And the third was a ticking clock, a date in early August that had traders bracing for impact. To understand that clock and to understand the real story here, we have to rewind to February. Because 5 months before the IPO, SpaceX quietly stopped being just a space company. In February 2026, it absorbed xAI, Musk's artificial intelligence company, the one behind the Grok chatbot and the X social network. It was an all-stock deal, and it valued xAI at $250 billion. On paper, it looked like Musk was bolting a cutting-edge AI lab onto a rocket empire. In reality, he was bolting on a money furnace. Here's the before and after, and it's stark. In 2024, SpaceX on its own turned a profit somewhere around $791 million, pulled in xAI, and 2025 flipped to a loss of nearly $5 billion, even though revenue actually grew by a third to almost $19 billion. Growth going up, profits going through the floor. That's the kind of contradiction that makes investors deeply nervous. And the culprit wasn't hard to find. The AI side alone lost more than $6 billion in a single year. xAI brought in about $3 billion in revenue while burning roughly $14 billion in cash, meaning this one division was torching more money than every other part of SpaceX could generate combined. A senior analyst at PitchBook didn't sugarcoat it. Next to a normal software company, he said, xAI's finances look reckless, and it wasn't a one-year blip. In just the first quarter of 2026, xAI lost another $2.5 billion on a little over $800 million in revenue, a small slice of the company's total sales, but a giant share of its losses. SpaceX as a whole lost more than $4 billion in that single quarter. The bleeding wasn't slowing down, it was accelerating. Then there's the debt. xAI had been borrowing aggressively $16 billion in new debt in 2025 alone. So SpaceX took out a $20 billion loan and swallowed that debt whole, moving it onto its own books. By the end of the year, the combined company was sitting on a cumulative deficit north of $40 billion. Some critics think the whole deal was smoke and mirrors. One bearish breakdown called the math financial sleight of hand, pointing out that SpaceX's value jumped by $450 billion in a deal to buy a company supposedly worth $250 billion. In other words, it magically became worth $200 billion more just for buying something that loses money. That's one analyst read. Not gospel, but it's exactly the suspicion now hanging over the stock. Now, back to that ticking clock. Remember how SpaceX only floated a tiny fraction of its shares? That's what kept the price sky high, but it was always going to be temporary. The people who actually own most of SpaceX, the insiders, were locked out of selling, and those locks were about to come off. The company's very first earnings report as a public company lands on August 4th. 2 days later, roughly 20% of eligible insider shares can hit the market. More follow in waves through the fall, and if the stock manages to climb back above a certain level, even more can be released early. By December, close to half the company's shares could be freely trading. You don't need a finance degree to see the danger. A stock that's already falling, about to be flooded with a wave of new sellers. That's the cliff edge investors were staring at, and part of why the selling started before the shares were even freed. There's one more pressure worth adding, and this one comes from an old rival. Starlink built its lead by being first and being massive, thousands of satellites already in orbit while everyone else was still drawing up plans. But Amazon has finally entered the ring. Its satellite internet network, once called Project Kuiper, now rebranded Amazon, LEO has climbed toward 400 satellites and begun commercial beta testing, with plans for a full constellation of more than 3,000. Let's be fair, that's still a long way behind Starlink's roughly 9,600 satellites and 10 million users. Nobody is dethroning SpaceX overnight. But for a company whose single most profitable business is satellite internet, a deep-pocketed competitor finally showing up in orbit is one more reason for investors to wonder whether the best days are already baked into the price. So, on paper, the picture looks grim. A broken stock, a punishing valuation, billions in losses, a mountain of debt, a flood of shares about to hit the market, and a new rival circling the crown jewel. If that were the whole story, in serious trouble would be an understatement. But it isn't the whole story. Because while the stock was collapsing, the actual business kept doing something inconvenient for the doomsayers. It kept working. Take Starlink. Even with Amazon closing in, the satellite internet arm pulled in over $11 billion in 2025, with profits that more than doubled in a single year. Those 10 million users off roughly 9,600 satellites aren't a struggling division. That's one of the best businesses in the entire space industry. Then there's the core rocket business. SpaceX still launches something like 80% of everything that goes to orbit. Its Crew Dragon is the only American spacecraft cleared to fly astronauts to the space station. That's not a company on the ropes, that's a near monopoly. Even the AI division, the one bleeding cash, has already lined up staggering paydays. Alphabet agreed to pay SpaceX $920 million a month for years for access to more than 100,000 NVIDIA chips. Anthropic signed on for its data center too. Together, Reuters reported, those deals could be worth around $26 billion a year if they fully pay out. The money furnace, it turns out, might also be a money magnet. And then there was the rocket. Remember that launch that wouldn't fire? In mid-July, Starship aborted on the pad when 4 of its engines failed to ignite one of the sparks for the sell-off. But days later, on July 24th, SpaceX tried again. And it flew. Starship reached space, deployed 20 real Starlink satellites, relit an engine in orbit, and came down for a soft splashdown. It wasn't flawless, the booster came in rough, but a company in genuine freefall doesn't pull that off the day before. So, is SpaceX in serious trouble? Here's the honest answer. The stock is broken. The valuation assumes near perfection. And by merging with a company that loses billions, Musk turned a profitable business into a money-losing one drowning in debt, right as a wave of insiders lines up to sell and a new rival moves in on its best business. That part is very real. But the machines are fine. The rockets fly, Starlink prints money, and the AI bet that's draining cash today has already booked tens of billions for tomorrow. What's actually broken here isn't SpaceX the space company, it's the price tag the market slapped on it, and the wager that stapling a cash-burning AI lab to a rocket company was worth more than $1 trillion. The next few weeks will settle at that first earnings report, that flood of shares. Either this was a painful correction on the way to something bigger, or it was the first crack in the most expensive bet Elon Musk has ever made. So here's my question for you. Is this the dip that smart money buys, or the first domino in a $1 trillion mistake? Drop your take in the comments, I read them. And if you want to be here when that August earnings report drops and we find out who was right, hit subscribe so you don't miss it. I'll see you in the next one.